China's capital markets under siege, the tariff shockwave. In the heart of Shanghai, where towering skyscrapers symbolize China's economic prowess, a storm is brewing. The United States has imposed tariffs reaching up to 145% on Chinese imports, shaking the very foundations of China's capital markets. Wu Qing, chairman of the China Securities Regulatory Commission, acknowledges the immense pressure these tariffs exert on China's financial markets. Yet, amidst global uncertainties, Chinese assets are becoming increasingly attractive to investors. In response, China's central bank has unveiled a series of stimulus measures, cutting the reserve requirement ratio by 0.5 percentage points, releasing approximately 1 trillion yuan into the financial system, reducing key interest rates to encourage lending and investment, allowing insurance firms to invest an additional 60 billion yuan in the stock market. Despite these efforts, the real economy feels the strain. Export orders have plummeted, factories are idling, and the once booming manufacturing sector faces unprecedented challenges. China's leadership remains resolute, emphasizing long-term capital investment and support for A-share listed companies affected by the tariffs. The goal to stabilize and strengthen financial markets amidst external pressures. As the world watches, the question remains, can China's capital markets withstand the tariff onslaught, or is this the beginning of a new economic era? In the face of adversity, China's response will shape not only its own future, but the global economic landscape. Stay tuned as this high-stakes financial drama unfolds. Subscribe for more in-depth analyses on global economic developments.